I have an old story I always tell. A guy walks into a bar and orders a martini. Is it MRR? If the guy comes in every Tuesday and has for the last 4 years, then it is MRR.
Who will buy all the SaaS companies?
There's kind of a narrative violation because people are now publishing stats on M&A in 2025.
If I can't trust the quality of the revenue, I can't keep valuing these companies on the basis of ARR. Well, and CJ, you call this reoccurring, right? Which is
Yeah, you're the guy who did that.
There's an O in there. There's a capital O. Dave, do you have an example of pricing in the real world?
I now have this on my desk, and this is the Chase Sapphire guide to getting $2,700 worth of value from your $900 fee.
I think it was called It's the End of the ARR World and I Feel Fine. Dave, you like music. What's this a reference to?
It's REM. Please tell me you've heard the song. That I'm not so old. I'm the only guy that's heard the song on the podcast.
REM cycle, something like that.
From Mostly Media, it's Mostly Growth. Go-to-market strategist Kyle Poyer and CFO CJ Gustafson share smart takes on growing revenue and running a company. Pricing, unit economics, AI, leadership, candid insights for CEOs, CFOs, and CROs, or anyone else aspiring to climb to the C-suite. This is Mostly Growth.
Hey, thanks for listening. We'll be right back after a word from our sponsors. You just launched your new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is a cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage, and joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is PULLEY.com/mostlymetrics. Please, guys, I really need this. Pulley.com/mostlymetrics. Welcome back to Mostly Growth. We have the most famous business blogger on the podcast today. We have Mr. Dave Kellogg of Kellblog fame. Welcome to the show, Dave.
Hey, thanks for having me. Good to see you, CJ. Good to see you, Kyle.
You know, our audience, Dave, is a mix of numbers folks and marketing people. And I think you are the perfect intersection between those two worlds.
You're the Venn diagram.
This is my elevator pitch. I say I'm the only marketing consultant who can also speak to the CFO. There are many.
Before we get into your background and all your smart takes, a question for you, CJ. Did you have a record month at Mostly Metrics?
It was, some would say, the best month. But yeah, it was a record month, man. It was awesome.
The idea of having a record month cracks me up so much. I've seen so many companies from the VC angle who I know had a terrible quarter, but they were like record number of enterprise customers. And you're like, you went from 2 to 4, so that's good, but revenue shrank.
We had a listener write in and he said, you know what really grinds my gears is I hear from operators all the time that we just had a record revenue month, or this product just hit a new peak in revenue. And it drives me nuts that people fail to understand that the minimum standard for a software business is a record month. The alternative is basically death.
Yeah. Every quarter needs to be a record quarter. And of course, the thing people do now is they just take that record month and multiply it by 12 and say that's how big they are.
It's good to call up because we're about to get a lot more of these come January.
Well, speaking of SaaS companies having a record month, there are actually quite a few SaaS companies that are not having a record quarter or year. Our friends Jason Lemkin and Only CFO were poking around this topic. And so, Dave, I saw that you had read it online and posted about it. Who will buy all the SaaS companies?
I got to tell you one thing. I was on Twitter this weekend, as I sometimes am, and there's kind of a narrative violation because people are now publishing stats on M&A in 2025, and it looks a lot better than what this is saying. My personal experience is fairly consistent with the Lemkin post, right? Like, I'm worried that these $20 to $50 million companies, if you've got low growth, low EBITDA, that you're kind of a zombie. Whereas, 5-10 years ago, you get to 50 million, pump, 20% plus growth, not particularly cash flow positive, you could sell the company, right? There would be a buyer. And now I'm worried there wouldn't be, but I have some cognitive dissonance because the stuff I saw over the weekend was saying, hey, it's actually shaping up to be a pretty good year in M&A.
But are there no buyers or just no buyers at the price of their big round in 2021?
Great point.
If it's a profitable company, even if the profitability is low, doing 20 to 50 million in ARR, if they've got good retention dynamics, that's kind of a PE dream. But they're not going to pay a ton of money for it. They'll maybe pay a couple $100 million for that business, but that might have been a unicorn in 2021.
Yeah, so it's one of those, if a tree falls in the forest and nobody hears it, did it make any noise? Right, kind of questions, meaning if there is an offer but the board won't take it, was there a buyer, right? It's kind of the same sort of question. There was a potential buyer, but if you're trading down from your last round and your investors haven't marked it down sufficiently, they may want to just leave it at whatever mark they have it rather than sell it below that, right? So there's actually two things. There's what your last round was at, and then if there's been any subsequent changes to the mark on your investors' books. In some ways, the investors are incented to let it live on because a zombie might be better than a death, if you know what I mean. Because there's still hope. I can still carry it at some mark rather than take it down to, oh, shoot, we sold it for 20 million.
There's very different dynamics depending on who the board member is. So if you have a Series C or Series D investor that, say, put 100 million into the business, and it's a business that could sell for 300 million, well, they've got a preference stack on the business, and they'll get, that 1x back potentially, right? Or close to the 1x. It's the seed investors. It's the early stage folks who have a big preference stack on the company. They get screwed in this scenario because they had thought this was maybe the unicorn, the 1 in 100 companies that they backed at inception or very early stage. But now, even if the business sells for a few $100 million, whoever came at the end is getting their money back, but the early investors are essentially getting nothing.
The whole preference stack question, right? And obviously what comes off the top is the debt, which people don't talk about. And certainly in private equity, there's going to be a lot of it. And then after you have the various preferences of the different classes of preferred stock. So yes, I mean, I did a blog post at some point said that just because we all own shares don't mean we're aligned, right? And actually I have another blog post called Interest Misalignments in Silicon Valley Startups, and you're cutting right at some of these non-alignments. The preferred may get a very different outcome than the common. And when you're quote unquote underwater, the preferred will either get all or at least a material fraction of their money back, whereas the common, which is what the founders and the employees own, will get zero. And then offsetting that is the possibility of a carve out, right? Where you kind of offset the fact that the common was worth zero, but we're going to take some money off the top anyway.
And then the CFO and maybe the founder and a couple other key folks get a little bit of carve out to incentivize them to participate in the transaction. But otherwise, that's just additional
I get to wet my beak, Kyle.
Lack of value for just about everyone else.
I'm okay. I'm still going to Sizzler after this.
Yeah, CFO does okay in these situations, huh?
To go back to the question I think at the beginning though, is there a lack of transactions or is there a lack of interest? Because I do think for some sectors, especially those that predated AI, particularly sales and marketing tools, there is probably less interest than there was before. Or am I reading that wrong, Dave?
Yeah, so look, I think you're very smart to separate the two things. Is there no interest or are there no transactions? A plain old SaaS company, you're going to have trouble getting interest. And you could pick sales tech. It's a good example for a very crowded space, a lot of players. So if you don't have anything remarkable in your financial profile and you're just plain old SaaS, people are like, this is a $20 million company that's not very profitable, not growing very quickly, waiting to be killed by AI. So who wants to buy that? And the answer is nobody. So I think there is no interest. On the transaction front, which is more where Kyle was headed, it's just like, hey, there might be interest, but we can't pull a deal together because the price, it doesn't work for everybody. So the investors don't want to sell it. By the way, if you go back to the tweet, I still want to understand this tweet I shared with you guys, which is I'm in the middle of believing the Lemkin post. And then this weekend, this is why I posted it with narrative violation, because I had bought into what Jason and Only CFO were saying. I think this is Carta data. So this is ultimately Peter Walker at Carta coming out saying, hey, startup M&A is on fire. I think it's tuck-ins of AI companies, but I don't know for sure. This surprised me.
It's got to be team in tech. I can't believe these are companies being bought for their customer base.
This is deal count, not deal value, right?
Yeah.
Has he shown anything like this around deal value?
We should go look for that because it's a really good point. Deal count is maybe not the best metric. Certainly you need to see both. Look, you can argue, and we're not going to do our imitation of the all-in bros, but there's two reasons Sand Hill Road went new administration, because they would argue that both doors to exit were blocked, right? M&A by the FTC and on crypto. Those are the two issues that kind of made Sand Hill Road flip, in my opinion. So maybe M&A has gotten, maybe it worked. Maybe M&A, the doors are more open than I thought. Crypto, we talk about on another podcast, hopefully. But that's what, when I saw this, that's what went through my mind. It was like either these are tuck-ins or the FTC policy change really did result in more M&A, which it probably should. But I just can't believe it's traditional SaaS companies. I still think Lebkin's correct.
I think just about every big tech company, publicly traded company or at scale company, they have to have an AI story. They're probably not great at building this themselves. They're probably doing a tuck-in of an AI native company. And in some cases like Meta and Scale AI, or like some of these tuck-ins are actually quite large deal values, which is wild to me when it's more of like an acqui-hire. But they're to position these legacy companies as AI. On the more traditional SaaS side, to me, it feels like there's opportunity in vertical much more so than horizontal, because at least for vertical software companies, if you own the workflow, you start getting a pretty strong data advantage that you can use to build AI products. But CJ, I mean, you were part of a SaaS company that was a vertical specific company that sold in the last year or so. Was there anything you did specifically to make sure there'd be buyer interest?
I have the least popular blog out of the people on this podcast, but I have sold the most brake pads.
You blog? I didn't know you blogged, PJ. CJ has a blog?
I'll send you a link to it.
It's mostly memes.
Yeah, it's mostly memes. But for us, it was positioning ourselves as something that was durable throughout different economic cycles because we were being used for how people made money day to day. It was positioned as software that made independent mom and pop garage owners more successful. So it wasn't something that was going to go away overnight. In fact, they actually did better in down macroeconomic cycles. And we're seeing a lot of vertical software companies have really great years. Many of them operated in a way that was way more efficient but less sexy over the last 10 years. And it proved out to be a pretty great place to be. Because if you're horizontal and you don't really own any particular type of ICP or like you're hardened within the workflow, when you've also been burning a ton of cash over the last couple of years, your rule of 40 when you pop your head up is going to be pretty crappy. So for us, when we went to sell, it was a story around having a moat with a particular type of customer that was durable, but we also got to break even by the end too. So it wasn't just that we were rule of 40, it was you could take our whole growth plus a couple percentage points, and that's truly where we were.
I'm a big believer in vertical SaaS right now as a safe place to be, right? Because it's harder to displace a vertical solution with a vertical customer base, trust, industry knowledge, potentially content that can be used to train models. It's just a stronger position than to be horizontal, where I think you're much more vulnerable to getting wiped out by a thin AI app on top of a generative engine. What I think is happening in M&A, and I haven't quite scored it with this data, is I do agree with Kyle that the AI tuck-in thing is real because the big people can't build it, so they are buying it. But I wonder if even acquihires, reverse acquihires, quote unquote, even count in this, because technically they shouldn't, because they're not really M&A, are they? No, you buy a shell. Let me ask a question. Is a reverse acquihire M&A or not? It is. No, you leave the shell behind. You're taking the employees. So it would not probably count on this chart. But I also agree with CJ that the place to be is vertical SaaS because of defensibility and moats. I think scale is also good. If you're big enough, I think a PE firm will want to buy you and turn you around and get you more efficient. But I think the kind of subscale horizontal, back to the Lemkin post, 20 to 50 million horizontal, no AI story, I think that's a tough place to be.
Yeah, I think the big thing is you have to know who the buyer is and kind of reverse engineer the business around that. And so if you think the buyer is going to be private equity, for example, they want some growth. They don't want this to be a negative growth company, but generally path to strong profit margins, very high retention story, clear stickiness, and clear understanding of the market and how you could bring other folks into your platform and have a broader vision to get to 100 million ARR and beyond. But if you're trying to sell to an at scale company, like a big tech company, a strategic, they need your metrics to be better than their metrics, right? So if they're growing 20, 30%, and if they're at 20% profitability, your rule of 40 needs to be at least as good as theirs. And generally your ARR growth needs to be faster than their growth to build more of that growth story. And, growth right now is valued at such a premium. Folks need to be able to see that growth story and also believe that you're not diluting their overall, business in the public market. So you need to have incremental metrics. You need to have a growth story. And increasingly, you need to be able to align with the story they're telling the public market about the increasingly the pivot to AI, but really just whatever the story is they're telling the market around where they're going for the next 3 to 5 years.
All right, gentlemen, a topic near and dear to all of our hearts, ARR. So, friend of the pod, Brett Queener, man, this guy only makes hits. I think it was called It's the End of the ARR World and I Feel Fine. Is this like Dave, you like music. What's this a reference to?
It's REM. Please tell me you've heard the song. That I'm not so old. I'm the only guy that's heard the song on the podcast. But yeah, this is one of REM's big songs.
REM cycle, something like that. All right. Kyle, did you read the piece? What'd you think?
So I haven't come across this piece, but Dave and I have traded notes about the end of the ARR world for, I think, probably the last year or so. It's got to be at least that, right? I hate to be like the person that says it's the death of ARR because that's probably exaggerating things. But to me, the ARR story was that we believed businesses could be valued on the basis of their annual recurring revenue. Generally, because that was a shorthand for saying software companies would be profitable at scale. They'd be high gross margin, right? After they paid off the customer acquisition cost of acquiring a customer, what's left is a highly profitable business. Also, these are high retention, durable businesses. And so they could be valued on the basis of ARR and growth rather than profitability. But I think increasingly AI is, and not just AI, but I think a variety of revenue streams, a variety of different ways people are reporting their metrics are just leading us to not be able to trust what's actually ARR or what's being called ARR is ARR. And also just makes me doubt the quality of the revenue of many companies. And then that makes me say, well, if I can't trust the quality of the revenue, I can't keep valuing these companies on the basis of ARR. But Dave, what's your thoughts here?
I was one of the earlier ones to say that kind of ARR is dead line. I'm not super into that drama. If you go back, I did a talk at SaaS Metrics Palooza, and I had a picture of Achilles being dumped in the river Styx, right? I was saying ARR is the Achilles heel of SaaS, because I think it is. And I think, yes, Kyle, we've been going back and forth on this for a while. And it's okay, right? Like, I feel fine too, because the business changed. It's not a recurring business primarily, right? It's moving to be a usage-based business or an outcome-based business. All the SaaS metrics were defined with a recurring assumption. And the metrics kind of, I think I had another slide of that deck where it was kind of Atlas as ARR holding up the universe. And Atlas is shrugging, let's just say, not to mix metaphors there. ARR is kind of fading. And it's okay because the business model changed And all the SaaS metrics were based on ARR, right? Like, what's your churn rate? Churn ARR divided by starting. What's your NRR? It's ARR this year versus ARR for the same cohort a year ago. So we probably need new metrics, because right now we're kind of retreading the old metrics based on implied ARR, right? Which is just 4 times revenue, right? But I thought it was a great post. I work with Brett at Salesforce. I've known him a long time. He's a gas.
He's been on the Run the Numbers pod. So he's
okay. I know he's on one of your pods. Yeah, this is a good post. I read this thing twice.
Well, Dave, one thing I'm curious about, what are some of the biggest mishaps of, that you see when someone's calling something ARR and then you go, wait a minute?
So there's a lot of them. I mean, the first in this day and age is just doesn't recur. Back to the multiply by 12 joke, because literally people are taking that record month and multiplying by 12 and calling it ARR. There's a reason it starts with A, is that it was kind of rooted in an annual contract, right? So it would, renew on a renewal date, and it had a known value. If we're just taking a month-to-month agreement and multiplying by 12, where there's no kind of legal underpinning for that step, you can go, well, the math is ARR equals MRR times 12, but does it? Right? Because the ARR had an annual contract. MRR sometimes did. I think that's part of it. Is it's just a fundamentally different animal. Like, I have an old story I always tell. A guy walks into a bar and orders a martini. Is it MRR?
I was
right?
hoping you're going to tell this.
Yeah.
I was really
if
hoping.
the guy comes in every Tuesday and has for the last 4 years, then it is MRR, right? I think increasingly we're going to go the Snowflake direction. I think Snowflake just calls it product revenue. One of my favorite things is I Control F search the Snowflake S1, right? And there's 0 instances of ARR, right? You can't even find it in there.
The only times you sometimes find it is when they talk about how they aren't going to talk about it. Yeah, I think a big wake-up call for a lot of folks was when they saw the TechCrunch article about 11x. And, they were one of the early AI companies that was hitting these seemingly impossible ARR metrics, saying like, we just hit 10 million ARR in X months. And, nowadays announcements seem to be popping up everywhere. But it turns out, as, TechCrunch has reported, that they had a 3 or 4 month opt-out clause for a lot of their contracts. And there was a very high percentage of customers that took up those opt-outs. Even if they did sell an annual contract, if 70 or 80% of folks are opting out of that annual contract, it's not actually an, ARR type of business model.
I have a simple rule, which is if it is a customer, it has to count when it's no longer a customer, right? And if it is ARR, it has to count when it's no longer ARR. And the real sloppy thing would be to call it ARR, but not call it churn, right? Because we only report churn from customers over 5K, but we're going to report ARR from everybody, right? Do people do this? Yeah, people do. So yeah, counting trials as ARR is a big thing. And my rule is simple. If you count it on the way in, you got to count it on the way out. So, and by the way, I'm all in favor of, if you've got a huge trial program where lots of people try this stuff and 60% of the people go on to buy it, then just call that all sales and marketing expense. Don't call them customers. Don't call it ARR. Call it other revenue, and start your SaaS metrics from when they actually buy one. Just say you sell a 5K contract, like when they buy that. You can call the whole thing funnel, upstream funnel marketing, demand gen, where they happen to be using the product, but you want to call them customers and call them ARR.
The crime 3 to 5 years ago was using CAR, committed annual recurring revenue. So if you had multi-year contracts and it ramped over time, you would take the exit value, the largest, say it goes from 100,000 to 200,000 to 300,000. You just say it's 300,000 across the board. But then what ends up happening is you have a gap, no pun intended, between your gap revenue and the ARR. I know this because I've got caught doing it before. They didn't throw me in jail. I got out. But I feel like the crime now is annualizing numbers that can't be annualized. So I saw somebody on Twitter this week, and they were annualizing, I think it was Calendly or Pulley market, these basically prediction platforms, which is more akin to betting, where you it's a transaction and you either win or lose. And they were taking that and they were multiplying it by 12. And then people in the comments were debating if this was also recurring. So not only did you multiply a month of transactions by 12 to annualize it, but people are saying, is this also similar to ARR? And so this is where you get completely out of whack.
So super interesting, by the way, on the first crime, totally agree. And it also blows the CAC ratio, right? Because they're using CARR. Just say they spent 300 units of sales and marketing to
You're
get
right.
that terminal value of 300. They're going to say their CAC is 1 when it was really 3. Just like we said, ARR is Atlas holding up the world. It's going to break the mapping to revenue, but it's also going to break your SaaS metrics if you do that.
But I think we should say this isn't really a crime, right? Though, I mean, ARR isn't an official like accounting metric that people have specific exact standards that
It's
they need to
deceptive.
follow.
It's not a crime.
Yeah, it's not a crime. It's just misleading, whatever you want to call it, because there are no GAAP SaaS metrics, right? There's no GAAP CAC ratio. By the way, I thought there's a modified question, CJ, of whether you should count that at 200. Just say it's 1, 2, 3. How much ARR did you really acquire, right? If you really want to get an honest CAC, it's not 3. You can't pretend it was 3 the whole time.
But it wasn't 100 either.
There's a case for
Right.
2.
Yeah.
To your point about the recurringness, this is why I love my martini example, because there's no contractual relationship unless it's a club. So we're just going to forget some membership club. But if it's just my local bar and I walk in every Tuesday, it is what I would call empirically recurring revenue. And I think Polymarket or the betting markets could do that. I mean, if there's, right, those people, there's no contract that they have to bet every week. But if we have some history, we can look at how much they do bet every week. Look, I think that $17 martini is a higher chance of recurring than some SaaS contracts, right?
Well, and CJ, you call this reoccurring, right? Which is maybe
yeah, you're the
as
guy who did that.
confusing because it sounds like recurring.
There's an O in there. There's a capital O.
I remember you did the reoccurring versus recurring thing. Yeah, I remember.
A lot of people didn't like that. And I was like, first of all, I didn't invent it. I just wrote about it. And people didn't like my spelling either. But I do think that it's important if you have a model that has something that shows up at the same time frame, same amount each time. That's very different than something that's like the icing on top that allows you to have uncapped upside.
Yeah, basically contractually recurring versus empirically recurring is the distinction I made. Like it recurs, right? And here's the other thing about recurring revenue. There's the accountant view of recurring revenue, which is, oh, we're amortizing it across a period, so definitionally it's going to recur. And then there's the fact that the contract ends and we have a chance to renew the contract. So to me, recurring is more about, it's probably your definition of recurring is a contractual amortization. Because I think it's actually different from reoccurring too. It's like, will they renew? Because I thought reoccurring was stuff that just, it was my martini. That guy just shows up every Tuesday and buys one. He's reoccurring revenue. The recurring revenue is the amortization. But what about the end of the contract? Because that's really that's what we care about the most in SaaS, right? Is will they renew or not? And that's neither of those.
Yeah, is there a compelling event at the end? That's a great way.
Because that was look, go back, I'm older than you guys. That was the thing we were trying to fix. There was no renewal, right? You paid me all
Sure.
up front and I got my little maintenance fee. But SaaS was supposed to be about the renewal, right? Not about the amortization.
Dave, I think one thing that comes up in my conversation a lot with founders, and I work with companies that are thinking about, for instance, usage-based pricing or charging based on units of work or maybe even outcomes. And many of them go, well, if this isn't classic ARR, are investors going to penalize my business because I have a usage-based pricing model? What I tend to tell them is they're going to look at the underlying characteristics. Like, is the usage highly reoccurring? Is it sticky? Once someone set up the app, or do they keep using it? Do they use more of it over time? Or are you attracting hobbyists, project-based use cases, folks that are one and done? So I encourage folks to kind of be able to tell the story about the underlying characteristics of the business. But I don't know, where's your sense here? Have investors kind of gotten this and this additional complexity around usage-based models, or is it actually, valued substantially less than classic subscription revenue?
I think many people, they use implied ARR as ARR, right? Just tell me your revenue and multiply by 4, and that's implied ARR. So they're effectively using revenue. And I think over time, that's what's going to happen. The more these models get complex and the more people are just dropping in and buying drinks, and the more the revenue is volatile, it's just going to be your ARR is going to be 4 times quarterly revenue. Now, there are things that offset that, but even then, I mean, let's go down this rat hole. Oh, I have an outcome-based model, but to get the price they got per outcome, they needed to commit to buy 100,000 on the year. I'm very simple. It's either ARR or it's not, and if it's not, it's revenue. And then we can use revenue. But some people think you should analyze the baseline and analyze the overage, and maybe you will operationally, internally, right? It's good to know what people are doing. I'm not going to call only the bottom one ARR, and I'm sure not going to call only the top one ARR, right, including the overages. So it just leads you back to it's either ARR because you're an annual contract business and you're renewing annual contracts, or it's not. You've got some other model, and that model is ultimately converting to revenue. And if you want to run SaaS metrics, you can, but you're going to run it off 4 times revenue. And I think people will pay the same multiple for either type of ARR. To answer your question directly, I don't see people going, oh, this is empirically recurring, outcome-based. I haven't seen that. In fact, what I have seen is, oh, it's an AI company, so let's pay 4 times as much as we normally would. And who cares how they get their revenue?
Yeah, let's pay 4 times as much as we usually would for negative gross margin ARR.
It's hard to be a CFO, CJ, during these times. I feel your pain.
Bring a hard hat to work.
All right, we got a lot of virtual things, a lot of real world things, but it is time to talk about pricing in the real world. Take it away, CJ.
So I regret to inform you that we have recently become an Instacart family, and it is very hard to put the toothpaste back in the tube once you've started to not go to the grocery store anymore, let me tell you.
We're a DoorDash family, so I can appreciate that.
Yep, got a DoorDash addiction myself.
Do
I'm
you
in a
do the
DoorDash
Dash Pass?
12-step program trying to get off it. But
Kyle, do you do the Dash Pass for it?
It comes with my credit card, actually, the Chase
Yeah.
Sapphire. So they give you a free Dash Pass membership, and then they've got like a bunch of grocery stores, and free is a good air quotes in that. But I'll do that and do Amazon Prime, which gives me access to Whole Foods.
So we just did the annual plan for Instacart, which I don't know how I feel about that. Just what it says about the laziness of
An
my
annual
family.
plan, you're
Really.
committed.
Yeah, I mean, that's true ARR. It's $79, I think, for the year. But I was doing the math. It's actually a great deal because the fees go down. And if you think about like even just how much it costs to go to the grocery store with gas, I think we're actually making out like bandits. Now, Dave, what do you think of these membership type programs to get anything delivered to your house?
well, I like them. I use them too much. On the groceries in particular, I always have trouble with expiration dates. This is an example where I'm not getting to pick the product and they give you a chicken that's, needs to be eaten tomorrow. So that's my issue.
Or you say you want bananas and then they give you apples or something. You're like, it was in the substitution list.
Yeah. This is an obvious substitution.
One thing that I find fascinating with it is when people have this sunk cost of a membership, like I think if you're an Uber or a DoorDash or whatever, the membership revenue is great. I mean, that's all profitability, but really you're driving up stickiness and order frequency. And so people start ordering way more frequently after they have a membership. And if you're in DoorDash, I actually realized they charge their restaurants more for an order from a Dash Pass member than they do from a regular DoorDash member. And the reason is because it's like if you're a DoorDash person, you are locked into the platform and that restaurant really needs to be on the platform to get access to a Dash Pass member. And so I find it fascinating that they're kind of like taking money on 3 sides, essentially. The membership, the increased frequency of ordering from members, and then higher merchant fees from those members.
Yeah, that's rough. I did not know about that. Look, membership works. The world's greatest company ever, Costco, if you've never listened to the Acquired episode on that. Like, I have a house in Oregon, so I do 8-hour drive, and that's what it takes to be able to listen to an Acquired episode. I listened to that one twice. And I was convinced that Costco is the world's greatest company. I mean, they started it all, and I think most of their margin comes from it, and all the behavior you cited is that, right? It increases stickiness, increases people need to go buy there. I mean, they do a lot of other stuff, right? But membership works for stickiness. Absolutely.
So me and Kyle were debating on the last episode, Dave, what the largest B2C subscription company was, and we were doing it for tech. And so what we came out to was it was Netflix, which is around 40 billion in ARR a year from consumer tech subscriptions. But I was writing about it this past weekend, and I was like, there's got to be a bigger company out there. Non-tech, it's Costco. They do over $5 billion a year in membership fees.
Yeah, I believe it. It's a huge part of their margin. Have you listened to the episode, by the way, the Acquired episode on that?
It's on my list. I don't have
Got
a
it.
ride as long as that, and my kids want to listen to Frozen when I'm with them. So
Should be golden now. Come on, we got to get them up to date.
And whenever I have a long ride, I listen to like the murder mystery podcasts that really should be like 1 or 2 episodes long, and somehow they're 10 episodes, but they're great for long drives.
I guess I'm the only guy that does Acquired. I don't know when other people listen to Acquired, because if I didn't do the 8-hour drive, I wouldn't know when to fit it in my life, but it's good.
Dave, do you have an example of pricing in the real world?
Yeah, I got one. Well, I mean, look, I now have this on my desk, and this is the Chase Sapphire guide to getting $2,700 worth of value from your $900 fee. And like, literally, it's like, if I'm going to keep this credit card and pay $900, I'm going to have to carry this with me to ensure.
It's gotten expensive. It was not expensive when it started, and now it
was not.
Really,
and Amex
really
is even
expensive.
more now. I think Amex is now $900. The pricing in the real world, to me, is just credit card fees. In this notion of basically fighting to get your money back, and hard, because it's like, hey, you get money back. Well, it's like, I gave you $900, and you get, dubious promises like a lounge. Like, maybe I just have terrible luck with these lounges, but the Amex lounge, like, almost could never get in. Sapphire Lounge, like, I just don't have much luck with them. There's a lot, as a marketing person, which ultimately I am, I just feel like it's a terrible promise, because you're promising this thing you're not delivering on with the lounges. And then all this, I call it coupon clipping, because that's what you're doing, right? You got to say, oh, I get, $200 at Goldman Sachs, but, oh, it's not even once a year. I have to go to Saks Fifth Avenue 4 times a year, in order to get my coupon, and I get $120 towards Peloton, but I don't have a Peloton. 300, on StubHub and Lyft. Now I have to use Lyft when I normally use Uber, right? And it just, I don't know, drives me insane, as you can probably tell from my tone. Like, you know what? I've got a better idea. I just won't give you the 900. Finally, the New York Times had a story on this where they had a guy who had a spreadsheet to track how to get his money back. And before he'd order a car, he'd have to go open the spreadsheet and be like, oh, what credit can I use? And which one of it? It's just like, I don't know how people have time for this. I sure don't.
Yeah, it's way too much work. I have the Chase Sapphire because I got it when they first started it, and they had this amazing deal, which now I'm like, the reason why they offered the deal is now they've made up so much money on it. But really, I think that they design the offers like based on my credit card purchase history. It's because I have a Peloton behind me. I use Lyft almost exclusively. I'm like a massive DoorDash person. And I feel like most of what I spend money on my credit card is for travel and restaurants. And so I'm like, I am the like perfect person for Chase Sapphire. So I don't treat it as a coupon clipping, but there are definitely people that do.
So you think you get the value automatically? You don't track it, and you think you get your value and then some?
Back of the envelope, I do, based on the percent they give you back from travel and restaurants and the amount that I put on my credit card from travel and restaurants. I haven't compared it to like Amex, but definitely pays for the membership fee. We've also got to get you to the Boston Logan Chase Sapphire Lounge. That is a very, very nice lounge. Best lounge in Logan. And
what airline do you have to be flying to be close to it? Because, American Express had one at SFO for a while, but it was at the far corner of a United terminal. So if you were on United, it was great. But if you were not, there's like no way to get there. International, you could wrap around. But I don't know. I just don't love that as a value prop.
Dave, you wrote down a topic that really grinds my gears. I got to tee up for this one. Resort fees.
So I think the craziest resort fee I ever paid was like at a Hilton DoubleTree kind of thing or whatever, like next to I-5, and there was a resort fee. And I remember like, this is like no resemblance like whatsoever to a resort. There's nothing. It's a truck stop. And you realize how permeated these things have become that we don't even notice them anymore. And then you step back and go, why did this happen? And I'm old enough to remember the halcyon days of the early internet where we actually had pricing transparency. Like for a brief moment in time, the internet was aggregating prices and you could see them. And then of course, immediately people did everything they could to jam radar on that. I would argue the creation of basic economy does that. So when you're quoting airfares, you often get basic economy as the lowest seat, even if I'll never buy it, certainly not at my size. So this idea of like just jamming transparency, because that's all it is, right? So when I go on Google Hotels or Kayak or Booking, whatever site you like to use, you're going to see one price, which invariably does not include the resort fee, right? And then, by the way, the other thing I'd say is like you need an MBA to book a hotel room right now, because you have to do probability calculations, right? Do you want this rate and no cancellation, this rate and 3-day, this rate and 14-day, or this rate and any cancellation? It's like,
yeah, and then you add breakfast to the mix, and like there's all of these different permutations.
Now I'm Googling, is there a food cart nearby or a bakery, right? Like you could literally, it's not, if I keep, like at the Hilton, New York, where I used to stay, there's a food cart right outside. It's like, why do I want to pay $40 for breakfast? I'll just get a bagel. Like, but you have to know this information. It's crazy.
I really recently ordered something on Uber Eats, and they have a section now that says just taxes and other fees. Taxes aren't 20% in Boston, and it's just that's where they hide their fees.
We went to Disney and they had a resort fee that basically equated to 40% of whatever the nightly rate was.
40%.
Oh, I believe that. Yeah.
It was so aggressive. And when I went to check out, it was like a couple $1,000s extra. I mean, I guess I signed up for that. But then also there was like a breakfast thing that was in there too, which is an egregious price. I bet it was like $40 per person, even though my kids are too small to even finish a whole bagel. But then it's like back to the whole credit card thing. Then you're like trying to claw back the value. You're like, everyone will eat breakfast this morning before we leave.
Stuff a bunch of croissants in your bag, grab some bananas. Yeah, no, I hate the $40 breakfast buffet as well. It's highly profitable for them, obviously. And the resort fee, I mean, at least you're at a resort, because sometimes you're not even a resort and you're paying one.
I think even more expensive than the lazy river was cleaning the lazy river.
Next up, it is something that I tried this week. The fellas tell us about something that they tried this week. Take it away, guys.
I can get us started. I tried a really hot tool. It's called PowerPoint. Ever heard of it?
Ooh.
So I was, with my like solopreneur business, I was really hesitant to pay for Office. I'm like, I shouldn't need that in the age of AI and Google Slides and all of that. Like, I just shouldn't need it. But the native chart capability in Google Slides is probably the worst product that's ever existed. And so I just had to pay for PowerPoint. The charts are just too good. It's way too good. I don't understand why anyone can't replicate that, but here we are.
Dave, are you a PowerPoint guy?
I still use Office. I was going to say the worst product that ever existed is OneDrive. Just we can go into that. But literally, you have it to sync your files. And I'm on an airplane without Wi-Fi, and my files aren't synced. It's like, yeah, we saved you space. We only kept it in the cloud. It's like, I have a 1 terabyte hard disk. Like, it's empty. Insanity. But in terms of stuff I tried, Wispr Flow. If you guys have used this, it is the best dictation tool, bar none. It does punctuation. It picks up weird names. Like you can speak to it about SaaS metrics and it will get them right. You say CPP and CAC ratio, it'll get them, right? It'll get company names. So you can add to it. Yeah, Wispr Flow to me, like, I didn't think it was a space you could differentiate in.
What do you use it for? Do you use it for like writing, but like you could just speak and then it'll write a LinkedIn post or something for you, or is it something else?
Yeah, you can speak a LinkedIn post, you can speak an email in response to field forms if there's a long field, like you're giving customer feedback, a Yelp review, like literally anything you could type. It'll just pop up in any app. And I use it mostly for, I'd say at this point, writing emails and writing posts.
See, I want to gift this to other people because there's nothing worse than getting a voice memo from someone. Like, I just hate a voice memo. And if I could just pay for anyone that sends me voice memos to just buy this product, I think that would be worth it for me.
Yeah. By the way, you just reminded me the number one use case I have is actually notes. So when I meet with people, I take notes after. I take paper notes during the meeting, but I just dictate notes and it's fantastic.
Can we ask you about scheduling norms, the right way to do it?
Okay. So, and this might be pretty specific to me, but I often introduce people to other people. Right? It's part of my job. And sometimes I'm making pretty high value intros. Like one time I introduced a guy who was in the space, we'll just call it X. And I knew an entrepreneur who'd sold a company for like $500 million in that space. And I was like, hey, I can connect you to this person because I know he likes to do a little bit of pay it forward, give it back, karma, whatever you want to call it. This guy is retired, but helps people out. So I make the intro and then the guy responds over email basically saying, please contact my EA to set up an appointment with me, blah, blah, blah. And there was no like, thank you for taking the time or like, it's amazing, you'll talk to me. So my entrepreneur friend comes back to me and is like, WTF, right? So rule 1 of introductions, don't embarrass the person who introduced you, right? Like I'm now embarrassed for having done the intro.
Yeah.
And then I went back to the founder and said like, you committed a pretty bad faux pas. And then he went off on me. And it's like, okay, so you've burned my buddy. You've now burned me. You're going to burn the VCs I work with because they're the one who introduced you to me. You've just burned a whole supply chain of intros all because you couldn't just say, how would you like to schedule? So I did a survey to see how people feel about Calendly.
This poll is shocking to me, actually. This poll, I would totally disagree with your poll.
I was shocked personally. So the poll was basically, how should you handle this use case? Should you ask them how they'd like to approach scheduling, which is my preferred answer? Hey, I'm really happy to meet you, Mr. Big Successful Entrepreneur. How should I schedule? I gave 3 cases. 1, ask them how they want to schedule. 2, propose specific times. Are you free Tuesday? I don't like this one because that person typically is super busy. If there's some big VC or there's some big CEO, right? They're not going to have time next Tuesday at 4, right? So that's why I do the ask them how they'd like to schedule. But then I said, send your Calendly link, and it got a 9%.
Holy
See,
shit, this got almost 500 votes.
Yeah, this was a good topic.
I guess we've learned that I'm extremely rude because anytime I'm getting an intro to someone fancy, I'm like, I don't want to ask them how they want to do it because that's adding an additional email in the flow that they have to respond to and doesn't actually schedule the meeting. So like that's out for me. Just creates too much back and forth for busy people. And then proposing specific dates and times, it feels presumptuous and like they're probably fairly busy. I'm happy to adjust my schedule to when they want to meet. And so I normally say, hey, I'm happy to whatever's easiest for you. But in case it makes things easier, here's my Calendly link. 9 times out of 10, either them or their EA just picks a time on Calendly and they have control over it. They can change the time if something came up. Like it's just easy all around.
I think you're big dogging him, Kyle.
Apparently so.
He is. Look, my personal answer is very simple. I don't think if it's a big enough introduction, the specific times is just not going to work. I send lots of Calendly, but it's more to like peers, customers, like regular people get Calendlys. It's no big deal to me, but it's like this special intro. And that's what I was trying to connote in this example. I would not send a Calendly, but I was surprised at the answers and surprised at the passion level. Yeah. 464 votes.
So next time Dave sends me his Calendly, I'm just going to feel bad for myself.
I'm not big.
I'm going to feel like I'm in the
I'm
crew.
a regular guy.
I'm in the inner circle.
Means you're trusted. You're in the circle. There we go.
Yeah. Dave, this has been such a blast. Thanks for carving out time for us.
Yeah, thanks for having me. It's been a lot of fun.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe. Give us 5 stars or hit like. The algorithm overlords thank you. Drink water, call your mom, and have a great day.